Welcome to the Europe chapter of the ISA Outlook 2026. Today, we'll pick out some highlights from our chapter. 2025 is a year that's felt at times like living through the film Groundhog Day. Or should I say, Un jour sans fin, the film's French release title. Transaction volumes barely changed, persistent bid-ask spreads, especially in Germany, remained. Decision-making from tenants was slow. And at first look, the lead up to 2026 looks a lot like the year before. But there's more to it than that. It's been a slow dawn, but a dawn nonetheless, with elements of the good, the bad, and the ugly. Watching that film, as we were writing Chapter 2, we thought it was a fair one to claim for Europe, at least partially, as it was filmed in Spain and it premiered in Rome. Let's start with the good. Occupier markets are solid and generally did not disappoint in 2025. London city prime offices beat rent growth expectations. Spain's strong GDP growth lifted residential and retail demand there. And Germany's stimulus in 2025 exceeded expectations on its size, even if its effects are proving to be lagged in time. Across our portfolio, lease renewals saw rents 3.8% higher relative to expiring passing rent. Meanwhile, the ECB hit its 2% inflation target. And together, these factors fueled a year of gradual positive capital value increases. And some of Europe's differences in 2025 versus other global regions led to falling REIT return correlations and diversification benefits.
But as any good Western reminds us, there's also a bad side. Vacancy rates for many European assets climbed in 2025, particularly logistics, which saw a cyclical downturn. London's residential markets have cooled, and peripheral office space in many cities still faces very weak demand, even as rents drop. US tariffs added to Europe's growth headwinds. Fiscal stress in France and the UK remains, while slow progress on needed EU reforms means policy risk remains high. We need to recognise and incorporate these weaknesses into our forward-looking strategy. Then there's the ugly. Political instability is at record levels. Just look at France with 5 prime ministers in 2 years. But the Euro's 28-year history brings resilience. Even in Italy's sovereign crisis, property yields remain steady by following euro-based swaps instead of volatile government bond yields. That history means markets like France can be more resilient to political stress than headlines suggest.
Let's go next to our 6 themes for 2026 investment strategy. First, euro-denominated debt is meaningfully accretive once again. The ECB has cut rates 8 times in 18 months. And at the same time, property yields have stabilized at higher levels. Together, that has widened the spread between go-forward property returns and borrowing costs. Similar dynamics boost the appeal of private credit-backed leverage strategies. Moreover, the difference in interest rates we see today between Europe and the US means that USD investors who hedge their currency exposure to euros get a return boost thanks to the rate environment. Our second theme, Britain is a bargain. The UK stands out for relative value. Assets with core risk profiles in high human capital locations, like central London leased hotels, are offering expected returns higher than at any point in the last decade, even with quite limited yield compression expected. LaSalle's real estate securities analysis underlines this further, with UK REITs trading at some of the highest implied yields of those anywhere globally. Our third theme is that diverging demographics are crowning a handful of city growth winners in Europe, even as much of the region faces real growth headwinds. Half of Europe's city regions will likely shrink in the next decade, while growth will concentrate in a handful of winning cities, many benefiting from rising defense spending, like Munich and Bavaria. That's where we're looking to tilt our portfolio. Meanwhile, niche sectors like student accommodation and hotels, because demand is driven in part by international demand sources, from more demographically dynamic regions, that offers a way to sidestep Europe's own demographic drag.
Our fourth theme is about accessing free market rent growth in residential markets. Complex and varying levels of regulation makes European rented residential distinct from other property types. Regulation has had the unintentional impact of limiting new supply in the most restrictive markets, leading to strong free market rent growth for the small fraction of units that are unregulated. Given that most of European residential stock is not free market, we believe the most compelling residential strategies target niche living sectors with clear free market rent growth potential, such as Spanish flexible living and continental European student accommodation. Another key theme is inelastic demand, especially for luxury high streets and central offices. Think London's Bond Street or Paris's Champs-Élysées, where global retailers pay what it takes for presence, pushing rents above inflation. Prime office demand is just as inelastic. Tenants are unwilling to compromise on location, no matter the rent discount, driving strong prime rental growth and giving redevelopment and renovation strategies a strong risk-return profile in markets like London and Paris. Our sixth and final theme, the gap between logistics and retail is narrowing. Logistics is seeing a cyclical downswing with vacancies increasing and rent growth slowing, while retail vacancy is falling. Retail parks and outlet centres, especially in Spain and France, stand apart for attractive income yields and solid growth prospects. Looking beyond short-term cyclicality, multi-tenant industrial continues to offer above-average risk return.
So, how are we looking ahead from here? We think we are breaking out of a Groundhog Day loop in European real estate, and accretive debt, solid occupier markets, and gradual capital value improvement is evidence of that. As we look ahead, it's clear that property type by itself is less dominant as a common denominator for our recommendations than it has been in the past. This increases the relative attractiveness of balanced versus single property type strategies. Real estate strategies centered on high demand niches, select retail parks and outlets, creating top tier office assets, those make up some of our top recommendations. We're still in the early scenes of this particular European movie. We'll be releasing the next North America and Asia Pacific chapters of the ISA Outlook 2026 in coming weeks. We invite you to continue to watch and read.